Okay. All right. Can everybody see my screen? Will you give me a thumbs up? And Jim,
Yes.
you tell me because
Yep.
I can't see yeah, okay, we're good.
Yep. We're
All
all
right,
good. Okay.
awesome. As Jim said, my name is Rachel Kennedy. I am the owner, team lead of the Kennedy Home Group with EXP and also partner with my husband of Raven Holdings. And Raven Holdings is what we're going to talk about today. Um, Legal note here, this presentation should not be construed as legal or financial advice. We're going to be talking about investment strategies today. I am sharing with you what I have learned and done myself, but I am not a financial advisor. So a little bit about me. I've been licensed in the residential space since 2014. My husband and I fix and flipped houses, mainly my husband, fix and flipped houses for 4 years. We just this year are starting to get back into fix and flipping. We've been investing in multifamily since 2022, and the multifamily space is what I am going to dig into with you here today. We currently own two rentals here in Denver, and we have a goal of being financially free by the time I am 45. It's my goal, but we're both working on it. Um, and I just turned 40 this year, so we have 5 years. The clock is ticking for us to be financially free, and multifamily investing is going to be the avenue that gets us there. So since March of 2022, we have added 517 units to our portfolio via multifamily investing. Now, when I say 517 units, that does not mean that we have 100% ownership in these 517 units. We have several partners with which we have invested into these units. They're broken up into a 64 unit in Nashville, Tennessee. We have a 248 unit development in Spring Hill, Tennessee. We have a 40 unit townhouse development. It started as a townhouse development, but right now we are transitioning that development into an industrial flex development in Grand Junction, Colorado. And then we have a 29 unit building in Cleveland, Ohio. And just this year, we added the 134 units in Jacksonville, North Carolina. So why real estate? I know that I'm preaching to the choir here on why real estate. I think we're all here because we know the value of real estate investing and the power of it. Why I love real estate is for its diversification. I love the fact that you can invest in real estate in several different asset classes, whether it be mobile home parks, storage, self-storage units, assisted living, single family, multifamily, etc. This is the only investment that I am aware of. If you're aware of any other investments that function like this, I definitely want to know about them. But this is the only asset that I know that you are able to acquire an entire asset with a smaller portion down, right? So if I want to go buy $100 in Apple stock, I first need to have that $100 in order to buy the Apple stock. Whereas with real estate, if I wanted, work with me here, $100 in real estate, I could come with just $20 to the table and borrow from the bank to acquire the rest. There's an element of controllable value, being that we can come in and increase the value of a property via fixing it up, increasing its income, maybe changing the business plan around a little bit. And then the tax benefits, which we'll dig into a little bit more here, I think in the next slide. And I love the fact that it's real property. I can drive by my asset, I can walk through my asset, I can touch it, I can work on it, I can feel it. I have a little bit of a fear around the stock market and cryptocurrency, just because it's it to me, it like floats out in digital space, right? And there, if I wanted to increase that that investment, it's out of my hands, basically. All right, so the tax benefits of investing in real estate. Most of these are going to cross between single family and multifamily space. The one caveat to that would be the cost segregation study. So we obviously know that we can write off depreciation of our asset. So being that we can depreciate windows, carpet, all those kind of things that, you know, depreciate in value over the time that we own the real estate. A cost segregation study, if you're not familiar with it, is a study that is done in commercial spaces where we can take 30 or 27 and a half years of depreciation and front load it into the first few years that we own that asset. So what it does is it significantly decreases our taxable income in those first few years that we own that building. The 1031 exchange option, I'm sure we're all familiar with how that works and how we can leverage that to our advantage. Writing off the loan interest, and then additional deductions are the operational costs. Any monies that we put into those properties are deducted off of our taxes. So large multifamily is defined as 5 or more units. It does require commercial financing. Right now in the commercial financing world, we are seeing banks lending anywhere from 25 on the high end to 35 to 40% of the loan to value. So right now in our environment, we're seeing banks require a larger down payment on these bigger assets. A large multifamily building is valued on the income that it brings in rather than the actual market value of a property. So if I have two buildings that are sitting right next door to each other and they're completely identical, and building A brings in $150,000 a year in operating income and building B only brings in $100,000 a year, then building A is worth more than building B. So how can you get involved in multifamily investing? You can get involved via a joint venture, which would be defined as 2 or more people going into investment together. All of the members of that investment have to have an active role in managing of the asset. If you do not have an active role, that's when it starts to turn into what we call a syndication. And I'll define a syndication here in a couple slides. And then, of course, you can buy into a multifamily building individually as well. So a syndication is defined as a group of investors who pool their money together to purchase a large multifamily asset. So in the multifamily space that we work in, we see assets being acquired anywhere from the $2 million range on the low end all the way up to $50 million. If we think about like Grant Cardone or these big hedge funds, Blackstone, BlackRock, they operate in that larger $50 million space. So the SEC defines, well, let me backtrack. When we are pooling monies together and one person's investment is dependent on another person's actions in managing that investment, the SEC steps in and says, all right, we have some rules that you need to follow here. So the SEC says that in order for you to invest in a syndication, you can invest in one of 2 ways, either in a 506c, which is open to accredited investors and can be publicly advertised. An accredited investor is defined as someone with $1 million of net worth or more, not including their primary residence, or making $200 or more in individual income for the last 2 years, with the expectation of that continuing forward. And then a 506B is the other way that you can invest into a syndication. And a 506B syndication is open to sophisticated investors. And a sophisticated investor is defined as anyone who has any type of investment experience. So if you own any rental properties, if you own any stocks, if you have a 401k, you are considered a sophisticated investor. More times than not, you will see syndications being raised as 506Bs, so that they are open to friends and family of the people running that syndication. A 506B syndication is limited to only 35 sophisticated investors. So if at the end of this class you are, this piques your interest and you're interested in getting yourself involved in a syndication, I would keep that in mind if you fall under the sophisticated investor umbrella, because those 35 slots can fill up relatively quickly. All right, so in a syndication, we have two different roles. We have the passive investor and we have the active investor. The passive investor is our guy on the top there, loving life on the beach, because he is considered what's called a limited partner or an LP. So he is invested into the asset with no day-to-day duties in managing that asset. Then we have our active investor, the guy down there changing the toilet flange, and he is considered a general partner or a GP. And the GP team is the team that is, their role is to manage that asset. They write the business plan, they raise the money for the syndication, they work side by side with the property manager throughout the entire ownership of the asset to make sure that the business plan that they wrote is being drawn out. So a few different ways that you can bring monies into a multifamily syndication. A 1031 exchange is a way to bring monies in. Not all syndications will allow for 1031 exchange monies to be brought in. Reason being is that there is certain rules that have to be followed when you are exiting the 1031 that don't really play well with a syndication. If you are curious about what that is, I'm happy to sidebar with you, after the class, and we can kind of dig into that a little bit further. You can bring monies in via a self-directed IRA or 401k, home equity, and then of course, if you are sitting on cash monies that aren't really making a return for you, syndications is a great option. So this is an example deal of our Cleveland property that we bought in December of 2022. And this is I'm going to use as a case study to kind of walk you through, the types of buildings that I personally and my partnership team invest in, and then what those returns look like for our investors, what the hold time is, kind of paint that whole picture for you. So this building, again, was in Cleveland, Ohio. It's a 29 unit, built in 2022. And we were intrigued by this building because it came completely furnished. So the way that you see these units in these pictures is exactly how a tenant takes possession of our units. And the reason why we loved that was because we are located just a couple miles away from the Cleveland Clinic as well as Case Western University. So this let us write a business plan around running a portion of those units as midterm rentals, which increased our rental market by 25%. So we were able to, if market rent was $1,000 for a one-bedroom apartment, we were able to increase that by 25% just by turning them into midterm rentals. So on the left-hand side there of the screen, you'll see some of the stats on the investment. So this was a 506C offering, meaning that it was open to accredited investors. The minimum investment amount into this deal was $50,000. The PPM is the document that all of the investors receive that outlines all of the terms of the investment and the agreement. So it's really in place there to protect the investor so that they know that if something goes awry and their management team does not perform, here is my protection. So the PPM became available to investors on 11/18. We gave them about, a week and a half, 2 weeks there to review and sign the private placement memorandum. And then they needed to have their funds to us by the 9th of December for a close date of the 20th of December. This is the investment snapshot. So we bought the building for $5.1 million. Our closing costs and operating capital that were required to be deposited into the bank via the lender added up to $150,000. So in all, including our closing costs and our down payment, we needed to bring $1.5 million to the closing table. So let's see, what else can I point out here? When we bought the building was occupied at 96% occupancy. In commercial lending, when you get below 90% occupancy, that's when the lender starts to downgrade how much they'll lend on the building and increase the amount of reserves that they would require you to bring to the table. And our hold period on this one is 5 years. So we closed on it in 2022, and we expect to sell it in 2027, if not sooner. So these are the returns that were presented to our potential investors. The equity multiple is a good, really quick way of just saying how much of a return are you going to be getting on your money. So if someone was to invest $100,000 into this deal, they would receive $98,000 in profit. The average annual return was 16.48%, and the internal rate of return is 19.6%. The equity multiple, the average annual return, and the internal rate of return, or the IRR, they're all metrics that you'll see very frequently, especially if you are seeing syndications. These are all metrics that are used to kind of tell you the strength of the deal. The structure of the deal, if you look on the right-hand side there, the partners structure. So this represents, as an LP, the percentage of the deal that the LPs own and their preferred return, or the return that they're promised before anyone else takes any profit from the deal. So the LPs owned 70% of the deal, while the GP team owned 30% of the deal. Now you'll see these fluctuate. I've seen it 50-50, I've seen it 60-40, I've even seen it 40-60, where the LPs own 40% and the GPs own 60%. Your typical structure will be a 70-30 split. And I would recommend definitely paying attention to this. If you come across a syndication where the GPs are owning the majority of the deal, then what that tells me is that my question is, how incentivized are they to really make this deal perform? When the LPs own a greater amount of the deal, the GPs have a little bit more legwork under them before they're able to take any kind of profit from the deal. And then the preferred return is just the GP team saying, LPs, we will guarantee you, or we will give you an 8% preferred return before the GP team takes any kind of split on the profits. So this is just the returns modeled out one more time. So we have our on the left-hand side, the net returns. You'll see those same metrics, that investor IRR there, your equity multiple, and then your average annual return there on the bottom, the 19.6. I'd like to draw your attention to the right-hand side column. And what this models out is a hypothetical $100,000 investment in our projected returns. So you'll see in year one, a $100,000 investor would receive $8,600 in cash flow. and then the subsequent years following. So if you go down to year 5 and float over to the third column to the right, it says capital event cash flow, the $167,000. So the $167,000 represents the return of the initial $100,000 investment plus a $67,000 profit from the sale of the deal. Now, when I see returns like this, it tells me that my cash flow throughout the hold period isn't super strong, but I'm making a really good return on the sale of the property. And then if you look over on the right-hand side under that second column, the hypothetical $100,000, did I say your left-hand column? Left-hand column, second section down, hypothetical $100,000 investment. Under the total investor distributions, that represents the initial $100,000 investment plus a profit of the $98,248. And if we go back to our equity multiple, we had a 1.98 equity multiple, just so you guys can see how those relate. So this is probably my favorite slide of the slide deck. This shows the power of compounding your investments. So I've taken a hypothetical investment into the deal that we just reviewed. And after the 5 years, you've gained the $98,000 in profit. And then let's say after you exit that deal, after the 5-year hold period, you take your original $100,000 investment plus your $98,000 in profit, and you say, all right, that was fun, I'm going to do that again. And you roll it into a deal that looks exactly like that first one. In 10 years' time, when you exit that second deal, you will have turned $100,000 into $392,000 totally passively. Meaning you didn't lift a finger, you didn't change a toilet flange, you didn't take a tenant call, you didn't have to go knock on somebody's door because they're late on rent. That is the beauty of the real estate syndications. It allows you to invest in real estate while not taking on all of the headaches that landlords have. This slide is another really powerful slide. Right here, I've modeled out for you the difference in investing $50,000 in 3 different ways. So in our first example on the far left-hand side, we have a $50,000 investment into a high yield savings account. So hypothetically, we're earning 4% interest over 10 years. So in 10 years, I've turned $50,000 into $74,000, or I've gained $24,000. In that middle column, we have $50,000 into a syndication today, or in the next 12 months, let's call it. We invest into a deal that has a 1.8 equity multiple, or we expect to receive an 80% return. So in 10 years, we've turned $50,000 into $162,000. So you'll see here that I have an equity multiple for every 5 years. So this example shows investing into 2 different 5-year syndications. So in 10 years, we've turned $50,000 into $112,000. And then in our very last example, we have $50,000 into a syndication, but it's 5 years from now. And in 5 years, we've turned $50,000, or I'm sorry, in 10 years, we've turned $50,000 into $109,000, or we've gained $59,000 in profit. All right, and that is the end of my slideshow, or my presentation, my class. My contact information is here. If you scan that QR code, it should take you right to our website, ravenholdings.net. On there, you can kind of explore like what my husband and I are about, the assets that we have invested in. We also have a newsletter that I put out. I also have kind of an educational piece on there. So if you're interested in learning more, that would be the best way to connect with me.
That's great, Rachel. Thank you very much. I noticed there are no questions in the chat box, and I know you all know how to type, but let's open it up and you can unmute yourself. You can put yourself on screen if you'd like.